All right, for more on the market sell-off, let's turn to longtime bear David Rosenberg of Rosenberg Research. David is known for serving as Merrill Lynch's top North American economist from 2002 to 2009. David, it's always great to get your take on things. You say that you're seeing signs of intensifying economic strain in the economy. So how do you feel about the Fed, what is expected of the Fed, and that's 50 basis points in December, if that economic strain is in fact intensifying already?
Well, I don't think you can argue against what the Fed is already signaling to the market. And I think they've already signaled that 50 basis points is coming our way in mid-December. The question is going to be, what is the tone of the press statement? What is the body language and nuance at the post-meeting press conference? So the real key is what happens next year. I mean, the next meeting is right around the corner. It's really immaterial. It's really about the forward guidance. As opposed to what they actually do on December 14th.
But given what you're seeing right now, David, in terms of the households tapping into credit increasingly now, what do you think is going to happen with the economy over the next few months? Are there going to be signs that the Fed can actually say, you know what we're doing is working? The economy is, in fact, slowing considerably.
Well, I mean, the economy already is slowing. Notwithstanding Friday's non-farm payroll number, what everybody seemed to miss was the 0.3% decline in the work week. Aggregate hours worked down 0.2%. That hasn't happened since last January. So actually, you're seeing all sorts of indicators showing the economy is weakening. So nobody should be forecasting the economy is weakening. That's already happened pretty well all year long. The question is, do we start contracting? And a recession is an economic contraction. It's a haircut on GDP. And I think there's a very good chance that we're going to start to see evidence of that starting in the opening months of next year. So, look, the Fed already told us that they're prepared to have a recession just by their unemployment rate forecast, because they told us that they think the unemployment rate is going to 4.4% next year. And we'll do the arithmetic. We bottomed at 3.5%. You've never failed to have a recession with the unemployment rate up 0.9% off any cycle low. So they're already telling us that, yes, they're raising rates in an inverted yield curve, but they don't really care because it's for the greater good of killing inflation. Set ourselves up for the next upcycle starting in 2024. And I think that's really what the message is.
David, this is Julie. I wanted to ask about the mix of employment that you're seeing. Karen talked about this in terms of layoffs happening at the tech companies. Scott Galloway talks about a Patagonia recession. That is just so much hiring that's happened in the tech sector and, throughout the corporate sector. But the frontline work seems to be really strong. What implications does that have for the mix of the economic growth and output that we'll have over the next year?
Well, what's interesting is that, of course, the layoffs in the tech sector and the mega caps have grabbed all the headlines. But late last week, we got the Challenger numbers on layoff announcements. And they were well beyond just the tech sector. They ran a wide gamut across every part of the cyclical, sensitive segment of the economy. Whether it was retail or transports or manufacturing, it cut a wide swath. So I know that the temptation is always to talk about, well, look at this technology. No. When you take a look at the Challenger numbers, the actual survey, not just the media headline grabbers, the layoff announcements are cutting a very wide swath right now. It's really broadly based.